Yeah, thanks everyone for joining. I'm Julie Mentor. I'm the program director for transformative financing structures at Transform Finance. If you're not familiar, for over a decade, Transform Finance has been developing insights and actionable strategies for financial ecosystem actors. It's many of you here who are seeking to challenge legacy investment approaches and seeding transformative investment models. Thrilled to be hosting this webinar with Allison Lingain of the Ownership Capital Lab to really share key insights from our recent research briefing we released about a week ago, and then also hear from really delightful and experienced investors, Amon Anderson and Priya Parrish. We're recording this meeting, so it will be posted on our website and the Ownership Capital Lab website afterwards, so you can revisit it, or if you have to drop off before the end. So as we get started, feel free to keep introducing yourself in the chat, but also wanted to get who's in the room and a little bit of so we know who we're speaking to. So I'll share a first poll, and kind of would love for you all to share what best describes your role, and you can choose multiple choices if needed. Give us a sense of who's in the room. I'll leave this up for a few seconds. This is fun on my end. I'm seeing it come in. I like this part. All right, we're at 39 out of 48. So close. It's challenging too as more people join. All right, I'll pause now just to get a sense of so we all know who's here. I'm going to share that with everyone. A really great cross-section of folks, a number of investors, both asset allocators and fund managers, a lot of employee ownership practitioners, folks who are kind of with us helping to build this field, business owners, and many others. And a lot of others. Feels like my categories weren't quite right. So that is also a reason why you can introduce yourself in the chat. And then want to share a second quick poll, really kind of focused on folks who have that subset of folks who are really with investment experience, because the bulk of our conversation is around what we want to share is about investing, and want to get a sense of what experience folks might have around investing in employee ownership. Thanks for the folks who are starting to reply. Appreciate it. All right, and I'll pause here. And again, share it. And really interesting to see that we have a good set of folks who have made investments already in employee ownership. And so we'll be looking to you all to also share your experience, as we go along, and make sure we're learning from the richness of the experience of everyone here. Some folks who are thinking about it for the next year, not that many, and a lot of folks who are curious and just getting started. So hopefully this conversation helps you take that next step and to go from curiosity to action. So welcome everyone. And I want to say one last quick thing. If you could go to this slide. Yes. So we're going to be talking about investing, but we are not investment advisors. This is really just for educational purposes. So that is the legal disclaimer. And I'll hand it over to Allison now to kick us off.
So thank you again, everyone, for joining us in today's conversation. I'm Allison Lingain. I'm the founder of Ownership Capital Lab, and I've been in the employee ownership space for a dozen years, having co-founded Project Equity to work to bring employee ownership out of its silos and help a lot more people learn about it. Over the past 3 to 4 years, we've seen an explosion of new entrants who are really leveraging capital to grow employee ownership. So now my nonprofit initiative, the Ownership Capital Lab, is focused on helping our capital marketplace mature and expand. And we do this really on 3 levels. First is creating connective tissue between investors, advisors, employee ownership funds, like we're trying to do in today's conversation. The second is assessing the need for then potentially launching new vehicles that may be needed to bridge financing gaps or get more capital to the existing funds in the space. And then the third is really testing strategies to unlock untapped sources of capital at greater scales. So we are joined today, as Julie mentioned, by Priya Parrish, Partner and Chief Investment Officer at Impact Engine. She's also the author of the newly released little book on impact investing. We encourage you to check that out. And Amon Anderson, Managing Partner at Acumen America. So we go to the next slide. I won't read the agenda to you here, but Julie and I are going to spend about 20 minutes sharing some of the high-level takeaways from all of these deep dive conversations we've been having with the employee ownership funds. And then we'll engage in dialogue with Priya and Amon and hear their thoughts about employee ownership investing. Really encourage you to join that conversation in the chat as well. Last 30 minutes, we're going to do small group breakouts for those who can stick around for that to explore these topics and potential solutions. So next
Allison,
slide.
I'm getting a note that some folks are finding you a little bit faint. I don't know if you can get closer to a mic or speak up a little bit.
Okay, just up to my volume. Is that better? Yeah. All right, well, let me
I
know.
think so, yeah.
Okay. So the framing for all of this is ownership lens investing. And what do we mean by that? So this is a growing movement. It's akin to climate or gender lens investing, and it focuses on expanding ownership opportunities of businesses, real estate, and other assets for individuals and households who are disconnected from the asset building tools that create wealth. Approach is gaining traction as a way to think about allocating assets for impact. And the urgency of scalable solutions to addressing inequality is paramount. Broad-based employee ownership is a powerful solution, and it is the focus of today's conversation. So first, a quick definition on the next slide. Broad-based employee ownership means that ownership is available to all employees, not just that top management layer. And today we're focusing on solutions that create ownership of at least 30% of the business within a few years of investment. We aren't focusing on which type of employee ownership. There are many forms that achieve similar benefits. And most employee ownership comes through transitions of existing companies through a sale by a retiring business owner, which requires capital to finance the transaction. Next slide. And we are at an incredibly important time for broad-based employee ownership in the United States. And yet, access to capital is significantly limiting the growth of this proven market-based and scalable approach to addressing inequality and to stabilizing our small business economy. So there is tremendous potential to expand employee ownership by providing easy and attractive external financing to business owners who are looking to sell their companies. From the perspective of investors, why is employee ownership attractive? So first, next slide, employee-owned companies are great businesses. They outperform their peers. They outlast them in business cycle downturns. Profit margins are higher, 8.5%. Sales and employment grow faster, 2.5% year over year. And this strong performance translates to very low default rates on loans of these businesses. Next slide. The National Center for Employee Ownership did a big study on default rates of ESOP loans. ESOPs are one of the main forms of employee ownership, and they found annual default rates under 0.3%. Yes, that's under 0.5%. Their data set was large, and it was drawn from a period that included the Great Recession, which is arguably one of the time periods when small businesses were more likely to default on loans. Okay, so stronger companies that pay back their debt. What's the impact from the worker perspective? Next slide. Employee ownership creates quality jobs. This data is from the National Center for Employee Ownership as well, and it shows that employee owners earn wages that are a third again as high as their peers in non-employee owned companies, and they have assets as measured by household net worth that are nearly twice as high, right? This is the connection back to ownership lens investing. And their work lives are more stable with 53% longer job tenure. Employee ownership is so needed and very relevant today. The silver tsunami of retiring business owners affects half of all employer businesses in the United States. Nearly 3 million companies need to find a buyer, creating a massive opportunity for employee ownership. And right at the time when we desperately need scalable solutions to address inequality. It's also a very flexible approach. There is an employee ownership solution for businesses of all sizes, all the way from companies at the bottom of this chart, which is 10 employees, of which there are a lot, right? All the way up to any size of business. And given the silver tsunami, half of the companies in each of these size ranges needs to find a buyer. Employee ownership means that every company has a built-in buyer group, which is where the need for investment capital comes in. So next slide, when you think about investing in employee ownership, we want to think about the return, obviously the return profile, the asset class, and of course the impact framework. So let's start with the return profiles. Investment opportunities in established employee ownership funds are in clusters from catalytic to mid-range to quote unquote market. Now we put market in quotes because it depends on what you're comparing employee ownership to. Remember that low default rate, and remember the outperformance of employee-owned companies compared to their non-employee-owned peers. So the question really is, what's the right risk-return relationship for employee ownership? Now, the numbers here in the bars, the 8, the 4, the 9, these are the numbers of funds in our report that are raising capital based upon these return ranges. So why is there such a big range of returns, or perhaps better asked, how is the higher return generated? So this view here is purposely a very simplistic view to show that most of the closed-end funds bridge what we in our space call the seller note gap. So it's on the right-hand side with mezzanine financing. So let me explain what I mean by that. So starting on the left here, let's say I'm doing an ESOP transaction. I go to a bank for financing. Maybe that bank will be able to provide 50% of the transaction financing, requiring the seller to stay in with a 50% seller note, or sometimes even more than that. If you're a selling owner and you're going to walk away from that transaction with only 50% or maybe only 30% of the transaction value on the day of the sale, that can be a challenge, right? The middle example here is the CDFI or CDFI style funds, and they're likely to be able to go to something like 70% financing, shrinking that seller note down to maybe 30. Their capital is limited, so these are mostly smaller deals. So on the right-hand side, what I'm going to call the sort of private equity style employee ownership funds, which is most of the funds in the non-catalytic buckets, they're bridging the seller note with mezzanine financing, often with warrants. Senior debt is still required. Some are also providing senior debt, but the goal is to be competitive with what private equity is offering in terms of that seller note, shrinking it down to 15 or even 10% of the sale price. So let's talk briefly about how to think about impact on the next slide. So I'm sharing a framework that I use to assess the impact of employee ownership. There is not a universal impact framework in place, and that's one of the needs in our space. But I look at 4 factors. The first 2 are about the specifics of the individual company, and the last 2 are about the structure or the form of employee ownership. So walking through them one by one. Who, so the target workforce. The most impactful employee ownership interventions are those that affect populations of workers who have been historically excluded from wealth generation opportunities, such as low and moderate income workers, BIPOC employees. And that ties back again to that definition of ownership lens investing, right? The second is how much, the percentage ownership. The most straightforward gauge of employees' upside is their percentage ownership of the company. To be certified employee owned, the company must be 30% owned by the employees, but best in class really is 80 to 100% ownership. The third, how long, this is the ownership durability. So models really range all the way from phantom stock that gives employees a slice of the upside in a near-term private equity exit, but then not necessarily any ownership ongoing after that, to 100% ownership that is enshrined in a perpetual purpose trust. And then finally, control or governance rights. The most impactful models center employee voice. And there's a spectrum from the ESOP model of a trustee designated to represent the employee interests, and all the way to the majority of the board being elected by the workers, or even a majority made up of employee owners. So I put a link here to an article published by Impact PHL this summer on the slide here, and maybe we could stick that link in the chat for folks who want to dive deeper. So then quickly on the next slide, yeah, here we go. We just pull it all together. You can line up your funds and assess them based upon the impact framework that works for you. obviously asset class and return profile mapped to your own priorities. So with that, I'm going to now turn it back to Julie, and she's going to share a summary of what we learned from our one-on-one deep dive conversations with the vast majority of the employee ownership funds.
Thank you, Allison. Yeah, the headline of this research is that the EO fund landscape is really full of opportunities. It's a really exciting time. If you go to the next slide. So yeah, if you're gonna, drop off and remember one thing, it's this. If you look at funds that create at least 30% ownership for employees within a few years of the investments, there are 27 funds that currently fit in that bucket in the United States, and they currently have about 500 million in assets under management. 22 of those funds are currently raising, and they're collectively aiming to raise $670 million. That means that if they achieve their fundraising goal, the fund's combined assets under management is going to more than double. And that's just an incredible opportunity to think about, like that level of leveling up. And this is why we're very excited about this moment that could really transform the state of employee ownership in the next year. So let's dive into some details here. There's kind of within this range of funds that I mentioned, the 27 funds, 10 of them are evergreen funds. So those are CDFI style funds. And combined, they're looking to raise an estimated $40 million. This seems small, but it's really a critical amount of capital because these evergreen funds play a really are focused on the deep impact end of the space. They're incorporating 100% employee ownership, providing significant governance rights to employees, and focused on bringing benefit to workers from communities that have been historically marginalized. So a really important section, though the total number is smaller from a dollar perspective. And there's also 17 closed-end funds. 12 of them are raising $630 million. One thing that's important to note when looking at these funds is they're very different from each other. And we're really at what we're calling kind of this Cambrian explosion model moment of fund models based on what kind of capital the funds deployed, the form of EO they use, or their investor terms. It makes the work of asset allocators who are new to this space a little bit more challenging. But well worth it. And I think a sign of the innovation and the excitement in the space at this moment. Next slide. Another fact that I think we were really excited about looking at this landscape is really the strength of the fund pipeline. So focusing here on closed-end funds, you can see, if folks come into the space, they might just see the fund ones and fund twos and say, oh, there's not that much going on here. There's 4 fund ones, 2 fund twos, no fund threes, 4 of these funds are raising capital. You can kind of like, count them on your hand. And it might feel like kind of a thin space, but actually coming out right behind these funds, there are 11 that are various stages of maturity. Some are just planning, developing their strategy, their fund structure, starting to hire, while others are really kind of at a proof of concept stage where they're closing a few deals to demonstrate that they can build the pipeline, that they have an interesting approach, and kind of as they get ready to raise a formal fund one. So that means that there will continue to be opportunities for investment. And that is like a really, there's a lot happening, and a lot more will be happening soon. I also want to touch on kind of the role of philanthropic and grant capital. So one lesson and one thing that we were interested to learn in the research is that really subsidized and grant capital play a critical role in this stage of the employee ownership capital development phase. First, most existing employee-owned funds have received grant support at kind of at that pre-development stage, what we're sometimes calling walking around money. It's the money to be able to pay yourself while you're figuring out your fund structure, starting to build a pipeline of deals, starting to hire a team. And that money can be really transformational for folks to cover their funds when they don't already have the assets to do that themselves, to self-fund a fund. But then also as EO funds kind of progress in maturity, they have tapped subsidized investment capital and or grant dollars, which allows them to either blend their capital stack, to blend lower cost capital with market rate capital, or to support pre or post transition work, for example, for ownership culture development. So there's a role, I think for all kinds of capital. in the space. And that's a really interesting and important point to remember. So next slide, please. So let's look deeper at these different kinds of capital. First, maybe because this was not, I think, obvious or self-evident to folks as we were talking, starting this research. Folks were wondering, like, is the issue capital as the limiting factor, or is the issue deals? Actually, are funds finding the deals they need to close? And if they had all the money they wanted, like, would they run out of businesses to convert? And at this stage, overwhelmingly, the limiting factor for growth is capital. And that's either capital to funds directly or the senior debt layer, which Allison was sharing earlier. So this is, the biggest limiting factor, and why, our work is really focused on that at this time. In addition, there's a number of enabling conditions that would really support the work of funds and of employee ownership more broadly. Policy change, that's something 30% of the funds mentioned. Narrative, an opportunity for more effective narrative and more awareness building, 25%, and then standardized impact metrics, 19%. So as a way for folks to be able to distinguish different approaches and identify the ones with most impact. So what does that mean for capital? If you could go to the next stage. Funds need capital at each stage of their life cycle. So pre-launch, kind of these startup costs, that walking around money, paying for lawyers, hiring staff, obviously at launch, right? When to be able to execute transactions, that's kind of their jobs. And then unique to this space, there's also this senior debt layer, right? Where often a transaction will rely on a capital stack of different kinds of capital providers. And that's another piece of capital. And then there's a range really of types of capital, as I alluded to. It's not just standard investment capital, but there's a role for grant capital, catalytic capital, market rate capital, even guarantees, whether funded or unfunded, can be really a key unlock for the space at this time. So if you go to the next slide, it all comes together in this beautiful matrix that is also in the briefing, if you want, time to consult it in a little bit more depth. But just to orient you briefly, you see across the top the types of capital, right? So if you're an asset allocator, you'd be like, I have these, these are the types of capital I have. And then kind of looking at each line, you can see where might your capital be well suited. So for market rate capital, that's a good space for some early stage, so capital for prototype proof of concept stage for some funds, or for closed-end funds that are at the higher rate of return. But if you have a foundation, you could leverage your endowment for guarantees, for example, an unfunded guarantee. So that's to give you a sense of there's something here for everyone. So that's that's a little bit more about the different kinds of capital. Next slide, please. So also want to talk about one of the challenges, kind of why even do we need grant capital or catalytic capital? While it's very true, as Allison shared, that employee-owned companies in general perform better, and ESOPs in particular have significant tax advantages that enable companies essentially to generate higher returns. EO also is a form essentially of granting a financial benefit to employees. And the employees aren't paying for that, right? They get either they're paying a small contribution to buy into a worker cooperative, but by and large, this is a free or very low cost benefit. And so that money has to come from somewhere. And that somewhere is often investor returns. And that means that there can be a trade-off between the percent of a company that is employee owned and investor returns. And that is why, as Allison said, that gold standard is to have 80 to 100% employee owned, but a lot of funds are operating with lower percentage employee ownership for kind of to manage this trade-off. And the challenge, right, if we're relying only on grant capital or catalytic capital to fund this work, is that that's a smaller pool of capital than is available kind of in the market, in the more general market. So really the dance is figuring out, how do we address this trade-off? How do we grow the space, not dilute impact, and accomplish benefit for workers? So the three strategies that we've seen, and there will be many more. One is to grow the underlying business. The more the underlying business is successful, the more it has profits that can be shared with everyone. The second is really blending capital, figuring out how do you bring in grant capital, subsidized capital, catalytic capital that can be brought together with market rate capital so that everyone's getting what they need. And then this, Allison alluded to, is really something that will be more and more important, is how do we think about really what market is, right? That's why we keep using quotes around market. Is really market rate is based on what people expect to get for this asset class or for these types of investments. And given the lower risk of employee ownership, is it fair to use the same benchmark that folks would be using for generic private credit or private equity? So as the field matures, I think we're hoping what is appropriate rate of return expectations really gets to be more established. The last thing I'll say here is, as we're thinking about sources of subsidized or low-cost capital, obviously a lot of foundations and high net worth individuals have been contributing to this and helping to get us to this phase of growth. And really, we need to think about larger pools of capital moving forward, some of which from the government, the CDFI, SBIC, others that might be more systematic ways of tapping grant capital from donor advised funds, for example. Or lower cost capital from donor advised funds. So a lot of opportunity and not all figured out yet. And so last slide to share kind of from the briefing is, how do we get to scaling capital? How do we get to this doubling in size or more of this space? And one of the things that I think keeps Allison and I up at night is like, how do we really make the most of this opportunity, right? It's not a foregone conclusion that the money will be raised and the space will grow. So how do we, kind of do that most effectively? Obviously, nurturing employee-owned funds across their life cycle, which we just discussed in some depth here, but that's not going to be enough. So we also need to think about expanding the financial infrastructure that supports employee ownership investing and employee-owned companies. So that's new capital products, vehicles, and policies that helps to unlock a different set of capital. That is kind of the next phase of work that we're thinking through now, of like, what are those and how do we design the right ones? We also need the third, kind of employee ownership everywhere. So how do we think about this as something that's part of every impact strategy, from climate to health? And how do we think about this as something that's part of every, everyone's who's investing in a small business? Like, how can that be something they think about, and what might be the role for employee ownership in their work? And then finally, really thinking about this as a movement for ownership lens investing that creates a compelling narrative that attracts a broad array of capital providers and business owners to this work, that helps to foster supportive policy, and then the development of clear impact metrics that really helps higher impact solutions get celebrated and financed. So there's a lot. And I know many of you here on this webinar are also actually working on all of these elements. So very excited to be at such great company. To join us on this journey, there's 2 invitations specifically for investors. One is if you're interested in kind of going deeper and want to really learn more about funds and what they are, you can scan. I don't know how well scanning works on webinar. There's also a bit.ly here to really kind of go deeper. This is something that Allison and I are organizing. And then Allison and a few others are also organizing an investor network as a place for folks to build community, share learnings, and really go from this, curiosity to action. And then when the webinar closes, you'll get a survey. So if there's other ways that you want to get engaged, please don't hesitate to share that with us. Thank you all. And with that, I'll turn it back to Allison.
Fantastic. Thank you so much for walking through all of that, Julie. And for those of you who have not yet been able to take a look at the briefing that we released last week, it is available on both of our websites, Transform Finance's website and Ownership Capital Lab website. So we are now moving into the conversation that I know you've all been waiting for, which is with Priya and Amon. I don't know if there's a way to spotlight them within the Zoom, or if that just happens naturally as we're in conversation. There we go. There we got one. Hi, Amon. And Priya.
No one asked for this, Allison, to see me. Okay, there we go.
There we go. There we go. That's what we like to see. Awesome. So yeah, thank you again to both of you for joining us in this conversation today. And just want to kick off with some introductions of you and your work. So Amon, over to you. Please tell us about Acumen America, how you see employee ownership, and maybe what types of employee ownership investments are interesting to you.
Fantastic. Well, it's really a privilege to be here. Thank you so much, Julie and Allison, and the rest of the team, your teams, for doing such important work to broaden this movement at this critical point in time. So just really feel privileged to be in this Zoom room together with you all. My name is Amon Anderson, and I co-lead Acumen America. Acumen America is a philanthropically capitalized evergreen fund, and we invest in early stage companies tackling problems of poverty across the US with the support of foundations, family offices, and corporate partners. We invest primarily in pre-seed and seed stage companies that are advancing the themes of health, work, and wealth for low-income Americans. We've invested now in 43 companies since our launch in 2015, and are really excited about some of our recent investments in this employee ownership space. Given our focus on work and wealth, employee ownership has been something really intriguing to our team, as it can advance both of these aims. As this work really underlines, our belief, and what underscores our focus here is the ability of employee governed companies to create better jobs for low-wage workers and address the wealth gap through delivering thousands of dollars in distributions to employee owners. As we think about what kind of opportunities are most interesting to us at Acumen America, we're looking for companies with the potential for impact at scale. And for us, that can mean, the scale and breadth of impact of an employee-owned business itself, or the potential for this employee-owned business to serve as a demonstration effect, or serve as an agent of broader systemic change. And we're still early in our journey here in employee ownership, but we've made a couple of investments so far in this space, broadly speaking. The first is in Every Table, which is a food company providing healthy and delicious and affordable meals that are accessible to everyone everywhere. And this company went on to launch a social equity franchise model that enables entrepreneurs from the communities they serve to own franchises that otherwise would have been unable to access due to the wealth barriers to franchise ownership, and have seen how those models can create pathways to intergenerational wealth for these largely low-wage entrepreneurs. And the second, more recently, earlier this year, was in a company, Obron Cooperative. Obron is a worker-owned cooperative conglomerate corporation, really rolls off the tongue. And we believe this has potential for meaningful impact at scale by rolling up employee-owned businesses and building a worker-owned holding company. We believe Obron can build a stronger balance sheet that helps them navigate some of the capital challenges that we're talking about here in this conversation. And they're also taking a powerful position on employee governance, giving workers the power that they deserve. So very excited to be a part of this conversation, and eager to do even more as we continue to build out our work in the employee ownership space.
Well, thanks for sharing that. And Priya, I'll ask you the same question. Tell us a bit about Impact Engine and how you see employee ownership, and what is interesting from your vantage point.
Yeah, thanks, Allison and Julie. Good to see a number of folks here that I know, and meet many other new ones for me. Impact Engine, we are an institutional impact asset manager based in Chicago. We've been around since 2012 and have always really built our firm with the objective of moving more capital to invest with impact. And so from our beginning, when we think about what kind of products we launch and what we manage, we think about, where are the gaps? What are the roadblocks to moving capital into an investment strategy that explicitly, intentionally, and measurably has an impact objective? And so early on, that was an early stage venture. We were one of the first impact accelerators. We were one of the first impact VC funds. Beginning in 2018, we launched one of the first impact private equity funds. And today we're really structured and have capabilities to do this kind of work, from venture capital to private equity, across 3 impact themes: environmental sustainability, health equity, and economic opportunity, but also by investing in funds as well as directly in companies. And so we have the experience with all of that. Employee ownership and an ownership lens came to us, and we began deploying capital in this space explicitly beginning in about 2018, when we launched our private equity fund, which is a hybrid strategy. We invest both in funds and companies. And when we think about asset classes and investment strategies. From an impact lens perspective, and from just an investor's lens perspective, there are multiple tools in a tool belt, right? And so a lot of people traditionally think about impact investing in venture capital as the product. What does the product or service do? Product-based impact investing. And that's a fine way to do it. And it's a lot of what, actually works in venture capital. But when you look at private equity in the middle market, which literally employs 1/3 of Americans, when you think about what is the impact opportunity, it can't just be limited to the product or service. And we started to see, especially as controlled buyout investors, that ownership, like not even the ownership we're talking about, just the fact that buyout funds own companies, there's a bunch of other tools. And so we came across ESOP funds initially as one expression or one strategy here. And so we made our first investment in a market rate fund called Mosaic Capital Partners. They're the only SBIC licensed employee ownership fund out there. And have also invested directly in a company with them called Zero Waste, which was a 100% employee ownership conversion to all the employees. That is actually one of the best performers out of anything we've invested in the middle market. And so one of the kind of key lessons for us that I think is important for this space is, it's not an asset class, okay? It's an investment strategy. And it's an investment strategy that is different depending on the asset class. So what works for employee ownership in venture capital is, quite frankly, completely different than what works in the middle market. And the risk return profiles are very different as well. So if you are a field builder, activist investor, if you will, your job is not to say, what is this called? Your job is to say, what are the risk return attributes, and then what bucket can it go in? Because fundamentally, allocators do have to do that. So we bucketed Mosaic in private equity, even though it is technically making loans, it's private credit plus warrants, but it can achieve on a risk-adjusted return basis a similar return to a private equity fund, and that is exactly what it has done, and it has been one of our best performers. And so I think investors need to remember that return is one dimension, and I don't know any good investor who invests based on one dimension. In fact, they don't even invest just on two dimensions. It's not just risk, it's also duration. And if you think about a lot of these employee ownership funds, even the CDFIs, the yield and how quickly you get your return back, even if it's a low return, gives it a certain kind of attribute that can be bucketed in an asset allocation that already exists. And that's really, really important. So right now at Impact Engine, we're trying to look for ways to do more of this in our existing buckets. And at some point in time, we may think employee ownership is big enough to have its own strategy. So the last thing I just want to share in the little intro, a lot of my work, I've been in the impact and ESG world for about 20 years. And early on, I was also very early on in the development of what is now, the vast majority of stock equity strategies, which is ETFs. I was early in the hedge fund industry as well. And so part of what I do in my book is try to talk about how did this industry of impact investing evolve, right? What's the systems change? And it actually matches very much what literally happened for ETFs, for hedge funds, for private credit, for professional real estate developments, all the same. And I think employee ownership is going to track the exact same curve. And it starts with experimentation. It moves to early adoption, then acceptance, codification, and integration. The broad umbrella of product-based impact investing, I would say, is in codification, and employee ownership is in early adoption. And the most important thing, and the thing that gets an investment strategy to the hump, is actual investment. We can theorize about this all day, and Julie and Allison put up wonderful stats about why employee-owned firms can do very well. It actually doesn't matter. Until we have proof points of funds and companies that literally did it, and we have data specifically from them on returns and the employee impact, you will not see the mainstream investment industry market it. You will not see them adopt it. You will not see them launch it. And by the way, you will not see policy move. Right now, we need the SBIC on our side too, and we're having some issues with that too. So you need to see the dollars in order to get policymakers and institutional investors to actually act. So it comes down to these early dollars and these catalytic dollars. They just have to move in any way, shape, or form. We got to write those checks.
So basically what you're saying is, to anybody who is in a check writing capacity who is listening to this right now, you have such an important role. right?
That's right. And both from your professional checkbook, but you better get your other checkbook out, your personal one too, because there are a lot of these opportunities on the catalytic side. Some of them have been Kickstarter campaigns.
Hmm.
You can there is no one should leave this call and not write some check in the next 6 months.
Love it.
There's no reason
Absolutely.
not to.
That's going to be the quote that we lead with when we distribute this this webinar conversation out to the world. So, Amon, jump in here and share with us a little bit about, how you see that risk and return, and also anything that you may have been surprised to learn when you were first looking at employee ownership.
Absolutely. Yeah, and preach, Priya, really appreciate that. And, for your voice and your leadership. I mean, I think what, the lens that we bring to this work is sort of twofold. One is a sort of impact first lens and a catalytic and a desire to be catalytic as Acumen America. Again, we are a philanthropically capitalized investor, so grant dollars in the door, investing with an eye to return out the door, enabling us to take, off-market risk in service of extraordinary impact. And so we're looking specifically for, the extraordinary impact in the EO space as well. The second is the majority of our investing fits into a venture lens. And so, we sort of come in thinking about a deal as sort of, something that that approximates a venture capital strategy, the growth trajectory. And so that's, although we have flexibility on the return side, that's the sort of heuristic that we enter into. And so, and I think the third thing is really, thinking about, sort of venture capital norms and governance, investor, companies that migrate from, founder-led boards to investor-led boards. And so I think what drew us into this is the power of employee ownership to advance worker power, the power of employee ownership to create urgent and meaningful wealth distribution to low-income Americans at a time in this country where it feels like where it's clearly evident our failure to do so, has significant cultural, economic, and political implications. And so, the ability of this as a way to shift wealth and power is something that's very attractive. So we followed our impact intention into this space. I think what we learned along the way, where there was sort of a growth curve, is sort of, rethinking some of our norms around governance and in particular, and also around the sort of capital strategy. There's sort of neat silos or neat sort of components of each of those bar charts that you shared earlier, but great complexity within that. Those deals can look very different, particularly when you see a sector as nascent as this. There's the norms are forming, and there's there was a significant learning curve for us to come up to better understand how does our capital play in, how do we sort of understand the risk that surrounds us from a capital strategy perspective, given that this is such an emergent space as well. And then, although we were sort of drawn in by the worker power component, we also had to, come to terms with a very different role that we would play as an investor, not necessarily taking that, sort of investor director board seat role, but playing a different role in supporting, worker-led boards in terms of the companies that are most interesting to us. So, I think that what brought us in was our desire for extraordinary impact, this catalytic moment in the sector that you've, clearly laid out in this report. I think that, what we have a sort of a differentiated return expectation that allows us to take, differentiated a sort of risk in terms of how we play in this space. And I think where we had to accommodate or really come to understand, how where we play in and adapt our incumbent strategies is how we think about mitigating capital risk and thinking about the role of governance as it reflects the sort of worker power that is one of the principles that drew us in the first place.
Yeah, wonderful. And I appreciate you talking a little bit about your own learning journey, and that it did take you time to get up to speed. And again, that's one of the roles that we're hoping that we can play, Ownership Capital Lab and Transfer Finance, to help sort of get people there faster. But just taking a step back, what do you think? And we heard from you, Priya, about the stages, super helpful, and that people need to write checks, that we need to get capital in the space. Just want to open it up to thoughts about what it will take to double this space. What do you think it'll take for us to ensure that we can get that 670 million into those funds?
Yeah. I tend to take like a pretty pragmatic approach to this, which is that it starts with the principle that like none of this matters actually unless we can create significant scale. And so not just double, but like we need to like 10x that amount.
Yep.
Actually relatively quickly for this to like mean anything. And in order to do that, the pragmatic side of me comes at it from you are not going to convince people to change their asset allocation, whether it's high net worth investors, foundations, endowments, pensions, and their financial needs. What you can do is work within that. And what I mean by that is that there's no perfect fund. There's no perfect company from an employee ownership lens. There is a spectrum. And I think it's really good you guys drew a line around 30% and some of these other things, because you can't just say like anything. But even within that, there's like a range. And there are trade-offs. Sometimes there's not, but there often are, there's some trade-off. But the reality is even for the most like purpose-driven, which is a pretty like weak word, but like let's just use that, seller trying to sell their company, even if that's like equal, the nature of their business model, the nature of their cash flows, the nature of the valuation, the nature of so many things has actually a real effect around what kind of transaction can occur. And so we need funds that are doing, we need the catalytic as much as we need the market rate. In fact, perhaps the biggest impact we can have, and maybe one of the biggest impacts and why this movement has got legs, is what KKR did, which is not this. It's not this, and it rightfully shouldn't be labeled here. Yet doing it in maybe this like more diluted way actually influenced and allowed these other funds to exist in a deeper, more committed, consistent way around actually giving the ownership to employees. It's all needed. And so I think what you need to do is make sure that as many buckets of asset allocation and as many types of investors have some way to participate in this, some way. If we can get every single private equity fund out there to even do some kind of ESOPs as an option, the impact of that and the number of employees that will benefit dwarf this 600 million that's coming. But it's not to say that 600 million isn't needed and these funds aren't needed. They're both needed. And so that is really what it takes to scale. And so we can't be saying you're not impact, you're not employee ownership, you're not this, you're not this. We can't be purist about this. We've tried this in other layers and it failed. You need to say, what is the impact? What is the impact to the employees? Why? Why is it that? What is the trade-off? And then take that for what it is and place it where you want to place it.
Love it. Yeah, couldn't agree more. The more that we try and close out into a little corner and say, oh, this is the only good thing, right? The harder it is for investors to know what to do. So I absolutely agree that we need to be able to help investors understand and differentiate across and among the different strategies from an impact, return, etc. perspective. So over to you, Amon. Would love to hear your thoughts on what you think it would take to significantly grow employee ownership investing.
Couldn't agree more that we need wins, we need case studies that we can point to that demonstrate the viability of this, and need to celebrate kind of all attempts and sort of, build a big tent here. So I think, as Priya said, both of those feel critically important to, not just successfully close out these funds over the next couple of years, but build this into a true sector, that's times 10 or more. I also think there's, we've talked a little bit about the market making role that policy can play here too. How do we not just sort of like create an aspirational ideal around what the return profile might look like, but how do we also, as the early members of a movement, start to shape the policy incentives that could expand and enhance the return profile or enhance the incentives here as well. One of the things we've done, most of our investing to date has been in healthcare, and one of the things we've done is partner directly with state Medicaid agencies to see how they might be able to shift the incentives for managed care organizations who are ultimately the buyers of health equity innovation. How do we think about here for us who are in this room because we're in this, first movers tribe, really trying to advance this work as as a movement, how do we think about having the right conversations that could, expand the market and enhance the return profile, enhance the incentives? I mean, you call it out in your report, but I think that that's sort of, getting aligned on the policy, the sort of, impact measures, these sort of the narrative awareness. I mean, I think these things matter. I mean, it's obvious what we're talking about here is that no matter what your risk return profile is, really, no matter what your impact objective is, there are ways to slot into this strategy. Like, fit is not an excuse, to not invest in employee ownership. Like, there is room for everybody. How do we then create the right set of how do we appropriately create the right set of incentives that create accountability for folks to participate? I think those are the kinds of actions that are going to really multiply the scope of our shared work here.
That's great. And yeah, we know that employee ownership is broadly supported by everybody, regardless of their political perspective. So it more than crosses the aisles. It has overwhelming support by frankly, by everyone. So that's a unique thing right now in our country, and we need to lean into that. So I'm going to open it up now for Q&A. Julie, if you want to lift up some of the questions that we're seeing from the chat.
Yeah, sure. Happy to. And as always, way more questions than we have time for. So this is will be an ongoing conversation. Maybe the place to start is there's been a few questions and ongoing discussion in the chat about metrics and kind of how do we measure success? And in particular, when we're talking about some of the squishier pieces of like benefit to employees, kind of, are there benchmarks or ways that Amon and Priya, you're thinking about measuring success? So a little bit more on that, knowing that there isn't a agreed upon metric for employee ownership. But curious how you both think about that.
Yeah, I mean, for us, it starts with like, who are the employees? And then the next level is really both the expected, and then you crack actual once you're invested. The benefit of whether it's an ESOP, or I've invested in co-ops as well and other things, like what's the actual accumulation of profits from it. And then the next layers kind of are important as well, but I would say those are the two, like, who are they and what is the benefit and is it happening? But the next layer is always, I think there's this attunement towards, like, I find in this space a lot of people focus on, wage earners and low and middle income households, and that this is like the silver bullet and the thing that's going to address wealth inequality. Well, how about we just pay them more? I think there's a big risk in this space, and this is what I see with a lot of employee ownership funds. They're targeting low-income people, and they're actually not addressing the root source of why there's that income gap and wealth gap. And so I also think it's important to understand wage growth and wage disparities by race, by gender, not just what's happening on the accumulation side of an ESOP or EOT or whatever it is. So those are some of the fundamentals. I think it's always important, again, there's no perfect company, no perfect fund, but you do need to have guardrails as well. So if your thesis, right, and your tool is ownership and wealth accumulation through that, I don't know about you, but I personally, it doesn't mean I still want to be investing in a company who has no guardrails around employee safety. Or quite frankly, their product is something that I don't agree with, like firearms, right? So I also need to make sure all these other tools and dimensions of a business and an investment strategy are certainly aligned with what I want to be investing in, even though the change, the additionality and impact piece is focused on that, the employee stuff.
Yeah, I think our view kind of maps to that, largely speaking. I mean, it's the who, given our poverty focus, we're looking for companies that are largely employing low-wage workers, at least today, and we're looking for how big, how many workers will this serve today and in the future, either as a fund or a conglomerate or an individual business. how many, like the sort of engagement, like how many employees opt in to employee ownership, and really seeing, what that ratio looks like, how much of an impact, both through wage gains and through through profit sharing distributions or through accumulated wealth, over the course of time. And I think and then looking at different sort of metrics of, governance and participation. I think the harder thing is to, how do you measure, so I'm so engaged in this, webinar, my motion sensor light, keeps going off. So apologies for that. There we go. But also, how do we measure the sort of impacts of worker power? How do you measure, improved policies that take place that actually map to workers' needs, whether that's, PTO, maternity leave, all sorts of different things that really, combine, are sort of represent in the aggregate, the relationship of work to a worker. And I think one of the ways to do that is to actually talk to the workers. And I think that's another takeaway for all of us coming out of this call. Let's write checks and let's talk to workers around what ownership means. And I think, for us, as we think about defining impact, how do we also, as a firm, think about making sure that we're really elevating those voices? We understand we're conceptualizing this in the right way and hearing those voices, and to understand that this really represents, the impact that's possible in participating in a firm's wealth and participating in corporate power.
I think it's also important to know around these metrics again, like if it's really an ownership lens and it's not an asset class, it applies to every investment you have, every
Right.
single one of them. So, you should actually ask these same questions to I don't care, your financial advisor, to your mainstream PE fund. Is it just the partners who are benefiting from all this? We're talking about all employees. Of course we care about low income, but it's actually it's a mindset shift. Um, we want to get ownership right across everything.
Yeah, thank you so much. Allison, should we do one more question? I feel like we're right at time. Maybe we should transition to the breakouts. What do you think?
Yeah, I mean, maybe just any sort of closing thoughts from each of you. I don't know if you've been watching the chat or not, but we've got maybe a minute from each of you, and then we can transition to the breakouts.
I think for me, it's just this, reflecting on the excitement of this moment in time that and the report that you all created really, I think, underlines that powerfully, that, our actions, our inactions, I think can really affect the sort of slope and trajectory of, where this movement goes from here, and, feel really energized to, follow your leadership and be a part of this community. So thank you.
Yeah, I guess the last thing I would leave to, just like lessons learned from other impact strategies that have succeeded and failed, is that we can't forget the technical skill set and experience that's necessary to do this successfully. Whether this is catalytic or market rate or in between, actually the underlying investment strategy to all of this is private credit. And private credit is about underwriting cash flows. And so it's really important that we make sure the fund managers who are starting these funds and and those that want to, that we make sure they're led by and have team members who have that skill set. Because the success of this field is actually built on the success of these funds. And if they don't perform well, and well is relative to what they said their objective was, so 3% is not bad if 3% is what they were shooting for, but that they achieve it. And so it doesn't, there's a lot of passionate people about ownership who have been very successful in other areas of life. Maybe they are even, great venture capitalists. They'll probably be horrible cash flow underwriters. We need to get the right skill set to actually allow this to perform in practice.
Wonderful. Well, thank you both. And I know you may need to jump to other conversations, but want to make sure that we have everyone's contact. So we have, thank you for bringing up the slide. So everybody's LinkedIn are here, and just really, again, just so grateful for you joining us today and sharing your insights. And please, we welcome you all to connect with Priya and Amon on LinkedIn.
Thank you.
Yeah, thank you so much. So the way that we organize this webinar is around kind of an hour of presentation, really, to get insights. But what we have found is folks really value also an opportunity to connect in smaller groups and kind of strengthen our relationships and our movement. So what we're proposing is to switch to breakout discussions. And we have 4 topics here. And actually in this conversation, I actually got a couple more. But I think given the number of folks here, if we could get a couple, I think ideally we have 6 to, or more like 8 breakout sessions. So 4 topics: how do we grow awareness with investors? What new investment vehicles are needed? What impact metrics should we consider? How do we support emerging fund managers? And then the 2 more that we'll have are how do we unlock capital from donor advice funds that Katie will anchor, and then how do we scale deep impact, right? We talked, there's a question in the chat and we haven't had a chance to go back to it, but really, how do we grow deep impact EO also? As that Margot from Sea Commons will anchor. So if you, I'm taking votes now, or not necessarily votes, but if there's someone who is like, you know what, I'd love to also host a breakout on whatever other topic, we're going to make that possible. So I'm going to start setting it up. If Allison or Kurt, you could keep an eye on the chat and see what folks want to offer as breakout conversations. I'm going to start setting up the breakout rooms here. And I wonder, one question that we didn't get to in this, in the Q&A, but maybe to touch on, because it's in the briefing, we didn't touch about it much, is policy. So Allison, if you wanted to touch on some of the things that we've learned, and I'm sure there's folks also here who know a lot about policy, it'd be great to just touch on that. Obviously, we're, it's not our deep expertise, but can at least get started there.
Yeah, you mean while you're getting the breakups?
Yes,
breakouts
exactly.
Sure, yeah, absolutely. Yeah, so when we think about policy for unlocking capital or financing for employee ownership, it really falls in 2 main buckets. So the first is, and this is going to get a little granular for the people who don't live and breathe employee ownership every day, but the first is around a personal guarantee. So if you go into a bank, unless you're a very large ESOP, you're going to have a hard time getting that bank to lend to you without a personal guarantee. And so what happens is the seller is often asked to maintain a guarantee in addition to big seller note to maintain a guarantee on the other note. And that can be that for really impact focused sellers, that can be great, but it can also be a barrier for just sort of your mainstream business owner. So we do need legislatively to get the SBA to open up the SBA 7A loan guarantee to all forms of broad-based employee ownership that can be accomplished without a personal guarantee. There was a rule change that was rolled out for majority ESOPs that now allows majority ESOPs, but the rest of the employee ownership space, and it's really important because of that. Remember that slide about the size of the companies all the way down to 10 employees? The ESOPs are only good for companies about 40 employees and above. So we're missing out on a lot of employee ownership opportunity for not having that personal guarantee. And then the other is thinking about how do we leverage the government programs that create access to lower cost government capital. So right now there's the small business investment small business investment company, SBIC, under the SBA. And there is only one fund out of 300 that is leveraging that low cost SBA capital, and that's Mosaic that was mentioned on the call. And so what would it take for us to have, 5 or 10 employee ownership funds that are being able to access that or other sources of lower cost government capital? So I will leave it at that if we're ready.
Yeah, that's great. Thank you. Thank you all so much for joining, for your engagement. Really appreciate it. Wonderful to be in community with all of you in this work. Much gratitude to Allison Lynn for her incredible leadership in this area and for being a great partner on this research. So yeah, thank you all. Any final words, Allison?
Just to echo everything that you said, real gratitude for everyone's engagement, and do everything that you can to talk to the investors and get them to write those checks.
Thanks, everyone. Have a happy holiday.
Thanks.
Here too.
Thanks.
Hey, y'all.